when you've got these individual bonds, it takes a lot of time and management to ensure that the payments don't just sit in cash because, hey, if you can show me any type of cash-like investment that pays the same yield as bonds or stocks, talk to me because it doesn't really exist. Even high interest savings accounts are not paying very much these days. And if you're trying to manage all of these individually, there could be a lot of cash drag, right? Which certainly can affect the performance of your overall portfolio. So as you said, bond funds, because of their size, they're very efficient at reinvesting these cash flows quickly into additional bonds. And they do that as soon as one of these cash flows shows up, which actually helps offset certain things like inflation risk and interest rate risk and maybe even reinvestment rate risk. It's just a natural hedge.
Exactly. Now, okay, we're going to have listeners out there that say, yeah, but if I buy an individual bond, I know when it matures and I'm going to get my money back. And when I put money into a bond fund, it doesn't really mature because it just keeps buying new bonds. That is true. However, the bonds that the bond fund are buying all have maturities.
That's right.
And so yes, as they mature, they get reinvested into new bonds that are in the market. So there's actually a bit of a interest rate hedge naturally built into a bond fund that doesn't appear in individual bond portfolios. So something that bond investors will want to look at is the duration of the bond portfolio. Duration is just like the time frame. So if you look at a bond portfolio and it has a duration of 3, it's like buying a 3-year bond, right? Or 7, it's like buying a 7-year bond.